Hi everyone, Jason Ferris of Waller Financial Planning Group. And today I'm joined by my colleague, Jason Eliason, our Chief Investment Officer at the firm. With the first quarter coming to a close, I figured it'd be a good opportunity to grab him and talk a little bit about the markets in the first quarter. So Jason, we just closed the books on the first quarter of 2018. What stood out to you?
There were a couple of things that really stood out to me. First and foremost was the return of volatility or risk to the marketplace. The other is that we had negative returns, and this was the first quarter that we saw negative returns pretty much across the board since the beginning of 2016. That's 8 quarters. It's a bit of a rarity to see the markets moving up for so long. And in fact, I'd say 2017 was a bit of an anomaly. The volatility in the first quarter was not the anomaly. It's actually more normal than not. Now I will point out, coming on the backdrop of 2017, it probably felt a little bit worse than it was. We may have been lulled into a false sense of security. But if you look at the returns in 2017, there were 4 days that the market dropped by 1% or more. That was the fewest number of days of a 1% drop since 1964. To put that in perspective, in the first quarter we saw 6 days that the market dropped by 2% or more. So quite a different story. Additionally, the biggest drop in 2017 was 3%. On February 5th alone, the market dropped by 4%. Now, we love the ups and we hate the downs, but volatility is important. If we don't have market movements, we can't reallocate portfolios and we can't put capital to work in the marketplace. It's important to understand that if things just go up and never go down, things get bigger and bigger and bigger, like a balloon that's about to pop. And bursting markets are what is most painful.
So you mentioned quite a bit about some of the changes in the volatility that's occurred in most recently in this first quarter. So what do you think were some of the culprits or causes for this volatility?
Yeah, there are a few things that really stood out during the quarter. I would say government or Congress finally passing a spending bill is a big issue. We had a government shutdown, government almost shutting down again. That was a big deal. Also, the Federal Reserve increasing interest rates again in March. That marked the 6th time since they began this process in December of 2015 that they increased interest rates. There were a number of issues, both domestically, from a political standpoint, and geopolitical issues that really stood out. We started the quarter really focusing on a lot of the benefits of the tax cut for corporations. That should have been a pretty big boom for stocks. We closed the quarter much more focused on trade and potential trade wars. Now I'm going to point out that I'm pretty concerned about a trade war with China. It's something I don't think the U.S. can win. At the end of the day, I believe that the U.S. consumers are going to be harmed by this. And there are a couple reasons I feel that way. Number one is we play by a different set of rules.
And by we?
That's a good question. The U.S. plays by a different set of rules than the Chinese government. Industry in China has historically been subsidized or underwritten by the government, and that's just not going to happen to the extent that it will happen in China. It will not happen in the U.S. to that extent. And secondly, I actually think most of this is just political rhetoric. I think it's government trying to position itself to improve trade. I just don't think it's going to work well for us.
So much of the headlines lately have been, I'd say, slightly pessimistic. I know investors at times this first quarter have maybe been slightly more pessimistic than in 2017, a lot to do with the volatility. You've even sounded a bit pessimistic at times. How concerned should we be?
We should be concerned, really. It's in my nature to be negative, I guess. Part of our process is always worrying about what can go wrong and trying to solve for that before we think about what can go well. It's interesting. There are actually a number of reasons to be pretty upbeat in the near term. What we need to focus on, most importantly, would be positioning ourselves for a recession. Now, we don't feel recessions in the near future whatsoever, so those are reasons to be optimistic. So, for example, corporate earnings are still pretty solid, unemployment's still pretty historically low. Inflation still rather low, consumer confidence is pretty strong, and those are reasons that we should be upbeat. I'm a little less upbeat than I was, but I'm still upbeat. No one can say with certainty what's going to happen next. The unknown is that big unknown is always something that I worry about. But to this point, markets have gone up and they've gone down, and that is a certainty. Although what's happened in the past is not any indication that it may happen in the future. That's always a disclaimer: past performance is not indicative of future results. But to this point in time, every time the markets have dropped, they've recovered. It's taken a matter of time, but they've always recovered, and they moved to new highs. So what's important is we need to make sure that portfolios are allocated appropriately for you to be able to handle the volatile swings.
Jason, thank you for the insight. I truly appreciate it. I hope you enjoyed our conversation today. Just a brief summary of the 2018 first quarter market summary. For Jason's full letter on this, please visit our blog at waller.com/blog, and look forward to catching up with you guys soon.